Fidelity Index Funds for Beginners. Hey guys, my name is Andrii. Today we'll talk about different Fidelity funds, how to choose them, which things to look at when you're choosing them, and in the end I will give you a list of a few funds which will be a great point for you to look at when you start investing. So by buying a shares of an index fund, you're automatically at the same moment becoming a member of a bunch of different companies. And which companies are there in that index fund certainly depends on the index which that fund is following. For example, there are indices like S&P 500, which is the 500 largest companies in the US, or Dow Jones Index, which is tracking 30 companies of the US, or Nasdaq Index, or Russell 2000, which is keeping track of 2000 small cap stocks. And those index funds, which are following certain indices, they are passively managed, means there is no real person behind them choosing which companies to buy, because it's already decided that certain fund will follow a certain index, and it's good for the shareholders because they do not have to pay extra commissions to the fund manager who will otherwise pick the stock himself. So this problem is solved by investing in the definite companies which are comprising that certain index. And index funds making investing super simple nowadays, because with a single time purchase of the shares of that index fund, you're becoming a shareholder of dozens of different companies, and therefore you have a great diversification among different companies and sectors. And those will most probably have high returns in the long run, but only if you select a good index fund. So the first thing which we want to take a look at if you want to invest in the Fidelity Index Fund is the transaction commissions, because Fidelity Index Funds do not have that transaction commission for those who are having Fidelity as a broker. But if your broker is not Fidelity, but for example Vanguard or Interactive Brokers or Robinhood, then for you investing in those Fidelity Index Funds makes no reason, because you have to pay extra transaction commission, which is definitely not something that you want to do. The second thing you want to take a look at is the expense ratio for different index funds. Expense ratio is the annual commission that you have to the fund for holding shares of that fund. And that expense ratio is expressed in percents and may vary from one index fund to another. And of course you want to choose that index fund which has the lowest expense ratio. For example, if we take a look at Fidelity Total Market Index Fund FSKAX, the expense ratio for that fund is 0.015%. And if we take a look at another index fund, RIDEX Nasdaq 100 Fund Class C, RICOX, then the expense ratio for that fund is 2.33%, which is extremely big difference, and this 2.33 is way too high. If you would invest $10,000 in those same index funds, then with a commission of 0.015%, you would have to pay extra $1.50 every year as a commission fee. But for 2.33%, you would pay $233. So 1.5 versus $233. This is super huge commission which you don't want to pay for sure. And that is why expense ratio is something that you want to take a closer look as a first thing when you're assessing some different index funds. The next thing you want to do for sure is subscribing to this channel. It's free. Alright, and the next cool feature of Fidelity Index Funds that you can invest into mutual funds. And investing into them is not that convenient as, for example, investment in exchange traded funds, but mutual funds give you very cool feature, which is automatic reinvestment of all the dividends that you receive. So for example, you're holding some mutual fund which is paying you dividends. Basically it's free money that has been paid to you because you're just holding that shares, and that's it. And the best strategy is to reinvest that dividends, because it will give you a power of a compound interest, especially in the long run. So stocks pay you dividends, for that dividends you buy more stocks, and then that more stocks pay you even more dividends. And if you take a look at this chart, then you can understand the true power of dividends being reinvested after you get them. So if you do not withdraw your dividends, then the difference between your portfolio returns for reinvesting them and not will be huge. On this chart you can see the difference between your dividends being reinvested and not being reinvested in the same index fund, and the growth of your $10,000 over next 57 years would be tremendously huge, which is more than $2 million just for your dividends being reinvested back to your portfolio. So consider investing into mutual funds if you want your dividends to be automatically reinvested in the same mutual fund without transaction fees and commissions. So far we've talked about three main things. The first is when you're buying Fidelity Index Funds, you certainly want to be a client of Fidelity Broker. Otherwise, you'll pay a huge transaction fees for buying those index funds. The second thing is you want to choose index funds with low expense ratios, which generally just stops your money from being withheld for nothing. And the third thing we've talked about is you considering into investing in mutual funds, which will allow you to be your dividends automatically reinvested back to your portfolio. And those three things basically have a big impact on the index funds that you're investing in, but they certainly mean not a lot if you select just a bad index fund to invest in. For example, if that index fund has low returns or high risks, and for sure I know that the past performance cannot be indicator of a future returns, that's for sure. But what even can be? But past performance can be a good indicator of future risks. And if you're investing in something in the long term, for example, if you want to buy and hold ETF and forget about this investment thing, then you certainly want to select good ETFs. And now I'll show you a bunch of few ETFs which can be a good starting point for you to look at when you start investing in Fidelity Index Funds. So the first index fund you may look at is Fidelity 500 Index Fund, FXAIX. It has a super low expense ratio of 0.015% and it has a quite good returns for the past 10 years. Annualized average return for every year was 14.6%. If there would be only one index fund that I can suggest to you to look at, it would certainly be this one. The next index fund you kinda wanna look at is Fidelity Total Market Index Fund, FSKAX. It has also super low expense ratio of 0.015%, but it has lower returns. For past 10 years, it has been giving 14.2% on average every year. That's a bit less than in the previous one, but this index has holdings not only of the largest companies, but as well as mid-cap and small-cap companies, and therefore making you a wider diversification across the US stock market. And this can be useful if you don't want to get a higher returns, but a bit more stability in your investment portfolio. So in that case, you may take a look at this fund. The third index fund you may take a look at is Fidelity Large Cap Growth Index Fund, FSPGX. It has expense ratio of 0.035%, a bit higher, yes, but the returns for the lifetime of this ETF since inception has been super high, 20.3%. That's higher than previous two index funds. And higher returns generally mean higher risks. And that is true in case of this index fund because it has worse diversification among different companies and sectors. So it has higher returns, but on the other hand, it has higher risks. So I would not recommend investing in it on the long term, but for the time being, it's showing super high returns. So the first index fund was following S&P 500. It has good returns. The second I showed to you had lower returns, but lower risks. And this third one, high growth ETF, is showing higher returns and higher risks. And so far we've talked about only US domestic stock market, and the next ETF I want to show to you will be Fidelity International Index Fund, FSPSX, and it has expense ratio of 0.035%, but it has only international stocks, means all the rest of the countries except US. And this ETF has lower returns for past 10 years, which are around 6.3%, significantly lower, but if you wanna ensure more diversification among your portfolio in the long run, then some small part of your investment portfolio you want to put to this ETF. Not the biggest part, but some part of it, 20 to 30%, it's up to you, but it will give you more diversification among different countries, which is super important if you want to buy and hold and forget about this investment thing. Or if you want to continuously invest in certain funds, so you can choose some certain funds and invest into the same funds every time without making any additional changes in your investment portfolio. Alright guys, we've talked about Fidelity Index Funds, why you want to invest in them, what things to look at if you want to invest in them, and I showed to you a bunch of different index funds that you might take a look at as a beginner to invest. I hope you enjoyed this video. You can put thumbs up for me, and I'll see you next time.